After studying this module, you shall be able to know the meaning, objectives, and importance of financial statements, learn the fundamentals of final accounts, identify the type of expenditure, that is capital and revenue, prepare income statement and balance sheet, understand the closing and adjustment entries. The primary function of accounting includes computing the net results of operations of the business for the current period. To meet out this purpose, income statement and balance sheet are prepared. These two documents are popularly called as final accounts. It is the last phase of accounting process. The components of final accounts depends upon the type of entity. In the case of non-manufacturing entities, the business operations include purchase and sale of goods. That is why trading account is prepared to calculate gross profit. But a manufacturing entity is interested in computation of total cost of manufacturing the finished goods. For this purpose, separate account is prepared as manufacturing account. The following chart shows the components of final accounts for manufacturing and non-manufacturing firms. It's a simple case of sole proprietorship. On left hand side you see a non-manufacturing firm which prepares trading account, then profit and loss account and balance sheet. On the right hand side you see manufacturing firm which has to prepare first manufacturing account, then trading account, then profit and loss account and then balance sheet. The process of final account starts after preparation of trial balance. It is mainly divided into following two parts. One, income statement. It is prepared to find out the net result of the operations. It is subdivided into two parts. A, trading account. B, profit and loss account. Number two, position statement. It includes balance sheet showing the status of assets and liabilities as at a particular point of time. Basic principles governing final accounts. The final accounts are required to be prepared in such a manner so that the income statement and balance sheet show true and fair view of profitability and financial position of the business. The following are also considered in this regard. Number one, in the preparation of final accounts, proper distinction is required between capital and revenue items. If a capital expenditure is wrongly charged as revenue, then it will lead to undervaluation of profits. 2. The profitability of the firm can be known if and only if all personal incomes and expenditures are separately treated from the business income and expenditures. 3. Any such item or information, disclosure of which is material to judge the profitability, should be disclosed appropriately. 4. The matching principle should be applied strictly, which requires that expenses incurred to earn the revenue should be properly matched. For example, if during the year 1000 units have been purchased but 850 units have been sold, then cost of goods sold should be calculated in respect of 850 units, and this cost should be compared with the corresponding sale proceeds. 5. When revenue expenses have been incurred but the amount is heavy and the benefits are expected to be received in future also, then a portion is charged in current period and remaining should be deferred to be charged in future periods. Trading account. In the process of preparation of final accounts, the first step is to calculate the amount of gross profit earned or gross loss incurred. The gross profit is the excess of sales over cost of goods sold. It is the first stage in the preparation of final accounts of a trading concern, and the result of this account is transferred to profit and loss account. The trading account is prepared in T-shaped format. The items to be debited include the following. 1. Opening stock. It refers to the closing inventory of the last year entered in the books through the opening entry. Therefore, it always appears in the trial balance. It is important to note that in the first year of its operations, there will be no opening stock. 2. Purchases and purchases returns. The purchases account will have debit balance, and it shows the gross amount of purchase of goods and materials for the purpose of resale or to be used in production. It includes both cash and credit purchases. On the other hand, purchases return account will have credit balance. The net purchases are debited to trading account. Besides purchases return, following are also deducted from purchases. A. Goods given as charity. B. Goods given as sample. C. Goods taken by the proprietor for personal use. 3. Direct expenses. These expenses are incurred on goods purchased till they are brought to the place of business for sale. In addition, expenses incurred on production such as wages, power and fuel, factory rent, etc. are also treated as direct expenses. The following are some of the important direct expenses. A. Carriage or freight or cartage inwards. It refers to the cost of bringing materials to the godown of the firm and making them available for use. It is important to note that if such expenses are in connection with purchase of fixed assets, then the same are capitalized and not taken to trading account. B. Manufacturing wages. Wages paid to workers in the godown / stores should be debited to the trading account. If any amount is outstanding, it must be brought into books so that full wages for the period concerned are charged to the trading account. However, if wages are paid for installation of an asset, it should be added to the cost of the asset. This account is credited with the following. 1. Sale and sales return. It reflects the total sale of goods by the firm during the period. It includes both cash as well as credit sales. The amount does not include sale tax or value added tax. There may be sales return also. So, net sales are to be disclosed to the credit of trading account. 2. Closing stock. It refers to the unsold goods lying in the godown of the firm at the end of the period. As per the convention of conservatism, the stock is always valued at law of cost and net realizable value. It is usually given outside the trial balance as an adjustment and is recorded in the books through the following adjustment entry. Closing stock account debited to the credit of trading account. Balancing of trading account. After having entered the items to the relevant side of trading account, the totals of debit and credit sides are compared. If the total of credit side is more than that of debit side, the excess is gross profit. Closing entries in respect of trading account. The following are relevant closing entries. For items on the debit of trading account debited to the credit of opening stock account, to credit of purchase account, to credit of wages account, to credit of power and fuel account. For items on the credit of trading account, sales account debited, closing stock account debited to the credit of trading account. For gross profit, trading account debited to the credit of profit and loss account. In case of loss, following entry would be passed. Profit and loss account debited to the credit of trading account. Format of trading account. The format of trading account is as follows. On the left hand side, you will see the debit items. We start with to opening stock, debit purchasing account less purchases return, then debit wages, debit direct expenses, debit carries inwards, debit freight, octroi and cartage. The balance is gross profit transferred to profit and loss account. On the right hand side, you find by sales less sales return, by closing stock, by gross loss transferred to profit and loss account. So the two sides will balance. Illustrations. Vidisha traders are in the trading business for last many years. They have provided you the following information for the year ending 31st December 2014. Prepare trading account from the same if closing stock is given at rupees 2 lakhs. The other information, stock as on 31/12/2014 1 lakh, purchase of stock 10 lakhs, carries on purchase of goods 10,000, wages 50,000, sales gross including sales tax rupees 1,50,000, which comes to 17 lakhs, sales return 50,000, purchases return 80,000, closing stock as on 31/12/15 is 2 lakhs, freight is 5,000, octroi 25,000. Solution. In the books of Vidisha traders, trading account for the year ended 31st December 2014. We will first concentrate on left hand side. The particulars are to opening stock 1 lakh, to purchases 10 lakhs, deduct from it purchase returns 80,000, which comes to 9,20,000, to wages 50,000, debit octroi 25,000, debit carries inwards 10,000, debit freight 5,000. Let's come to the right hand side. By sales 17 lakhs, less sales return 50,000, less sale tax of 1,50,000. So the net sales are 15 lakhs and the closing stock is 2 lakh. The balancing figure is gross profit transferred to profit and loss account 5,90,000 because the two sides must have the same total. Profit and loss account. It is prepared to calculate the net profit earned or net loss incurred by the firm in a particular accounting period. This account starts with the amount of gross profit or loss reflected by trading account. The gross profit appears to the credit side and gross loss to the debit side. All indirect expenses are transferred to the debit side of the profit and loss account. The administrative expenses include salaries, printing and stationery, postage, audit fees, rent and rates, etc. The expenses are also debited to profit and loss account. These expenses are salesman salaries, packing charges, advertisement expenses, export duties, bad debts, commission to agents, etc. There are some indirect incomes also, like dividend received, profit on sale of investment or machinery, interest received, etc. These are credited to P&L account. Items debited to profit and loss account. 1. Administrative expenses. A. Office salaries. B. Office rent and rates. C. Lighting. D. Audit fees. E. Journal expenses. F. Printing and stationery. 2. Selling and distribution expenses. A. Salesman salaries. B. Godown rent. C. Advertising. D. Delivery van expenses. C. Freight and carriage on sales. F. Packing expenses. 3. Finance charges. A. Interest on loan. B. Interest on bank overdraft. C. Interest element in finance lease. 4. Abnormal items. A. Loss by theft. B. Loss on sale of fixed assets. C. Loss by fire to the extent not covered by insurance. Items credited to profit and loss account. 1. Gross profit as per trading account. 2. Interest received. 3. Rent receipt. 4. Discount received. 5. Profit on sale of fixed assets. 6. Extraordinary gain. Note: the following items are shown separately in P&L account, one to the debit side and other to the credit side. Interest expense and interest received, discount allowed and discount received, bad debts and bad debt recovered. Closing entries in respect of profit and loss account. The following are the relevant closing entries. 1. For items on the debit of P&L account, profit and loss account is debited to the credit of salaries account, to advertisement account, to interest account, to rent account. 2. For items on the credit of P&L account, interest received amount debited, bad debt recovered account debited to the credit of profit and loss account. 3. For net profit, profit and loss account is debited to the credit of capital account. In case of loss, following entry would be passed. Capital account debited to the credit of profit and loss account. Format of P&L account. The format of P&L account is as follows. On the left hand side, you will find particulars like depreciation, legal expenses, loss by fire, salary paid. Add to that salaries outstanding, interest expense, carries outwards, discount allowed, net profit transferred to capital account. On the right hand side, you will observe gross profit, a brought down figure, by rent received, by commission received, less commission received in advance, by bad debt recovered, by miscellaneous income, by net loss transferred to capital account. The total of the two sides must tally. Illustration. Consider the following information in relation with Evershine traders. Gross profit rupees 5,45,000, discount received rupees 24,000, salaries rupees 1,24,800, interest received 11,000, miscellaneous income 17,400, bank charges 4,000, consultancy fees 21,000, loss by fire rupees 6,000, depreciation 54,300, audit fees 2,400, electricity charges 22,300, stationery 7,000, legal charges 32,400, discount allowed 27,000, telephone, postage and telegrams rupees 14,000, bad debts 10,700, interest 51,000. Prepare profit and loss account of Messrs. Evershine Traders for the year ended 31st March 2015. Solution. In the books of Evershine Traders, profit and loss account for the year ended 31st March 2015. On the left hand side, we will see all expense items like to salaries 1,24,800, to bank charges 4,000, to consultancy fees 21,000, to loss by fire 6,000, to depreciation 54,300, audit fees 2,400, electricity charges 22,300, stationery 7,000, legal charges 32,400, to discount allowed 27,000, to telephone, postage and telegram 14,000, to bed debts 10,700, interest 51,000. The balancing figure of net profit is 2,20,500. The total of this comes to 5,97,400. On the right hand side, we see the gross profit figure of 5,45,000. To this we add interest received 11,000, miscellaneous income 17,400 and discount received 24,000. The total of this is 5,97,400. Balance sheet. Balance sheet is a statement showing the total assets and liabilities of an entity as at a particular date. It is important to note that trading account and profit and loss account are prepared for a particular period as periodical statements. But balance sheet is a positional statement. It shows the financial position of the business on a particular date. Usually, in case of non-corporate entities, balance sheet is prepared in horizontal format, that is T-shaped format. In this case, the right and left hand sides of the balance sheets are called as assets and liabilities. Balance sheet is not an account. Rather, it is simply a statement showing closing balances of real and personal accounts. Arrangement of assets and liabilities. As such, there is no prescribed format of balance sheet for non-corporate business entities. Here, two terms, grouping and marshalling, are important. Grouping means putting together items of similar nature under a common heading like current assets, fixed assets, etc. Marshalling means the order in which the various items are shown in the balance sheet. The order may be liquidity or permanence. Format of balance sheet in order of liquidity. Liquidity means the most liquid assets like cash is shown first and least liquid assets like goodwill is disclosed in the last. Now look at the format. On the right hand side you see assets starting with cash in hand at bank, short term investments, bills receivables, sundry debtors, closing inventory, long term investments, furniture, plant and machinery, goodwill, and total of this item at the end. On the left hand side, you see liabilities starting with bills payable, sundry creditors, outstanding expenses, short-term loans, long-term loans, reserves and surplus, capital. Total them up and the two sides must have the same total. Format of balance sheet in order of permanence. Permanence means the permanent, that is least liquid item, is shown first and most liquid item is shown in last. You will observe from this format that the items are just reverse of what is shown in the above format. Now here on the liability side, we start with capital followed by reserves and surplus, long-term loans, short-term loans, outstanding expenses, sundry creditors, bills payable and total of them. On the right hand side, assets which are starting with goodwill, plant and machinery, furniture, long-term investments, closing inventory, sundry debtors, bills receivables, short-term investments, cash in hand at bank. Illustration. After having prepared the trading and profit and loss accounts, Evershine Enterprises provide the following information. Cash at bank 32,000, cash in hand 10,500, goodwill 25,000, capital 7 lakhs, plant and machinery 2,45,000, land and building 4,75,000, furniture 80,000, long-term investments 40,000, closing inventory 28,500, debtors 80,000, bills receivable 18,000, short-term loans 12,800, bills payable 12,600, net profit 99,600, sundry creditors 45,000, drawings 15,000, outstanding salaries 11,000. If the amounts of depreciations are 49,000 on plant and 95,000 on land and building and rupees 20,000 on furniture, you are required to prepare the balance sheet of the firm. Solution. In the books of Evershine Enterprises, look at the liabilities. We start with a capital of 7 lakhs, add net profit of 99,600. From this, deduct drawings of 15,000. So you get the balance of 7,84,600. Short-term loans 12,800. Sundry creditors 45,000. Outstanding salaries 11,000. Bills payable 12,600. And total of this is 8,66,000. On the asset side, we can observe goodwill 25,000, plant and machinery 2,45,000, less depreciation of 49,000. The balance is 1,96,000. Land and building 4,75,000, less depreciation of 95,000, giving a figure of 3,80,000. Furniture 80,000, less depreciation of 20,000, gives a figure of 60,000. Long-term investments 40,000. Closing inventory 28,500. Debtors 80,000. Less provision for bad debts 4,000. So the net figure is 76,000. Bills receivable 18,000. Cash at bank 32,000. Cash in hand 10,500. Total of this comes to 8,66,000. Adjustment entries. In final accounts, all expenses and incomes for the year are accounted for. So it is necessary to incorporate expenses incurred on due basis rather than on paid basis. For example, suppose the firm closes its books on 31st December and salaries for the month of December have not been paid. Now, this outstanding salary should also be debited to profit and loss account. Similarly, there may be adjustments relating to prepaid expenses, income received in advance, provision for depreciation, provision for bad debts, etc. The journal entries which are passed in the journal proper to give effect to these adjustments are called as adjustment entries. Now, some of the examples are: 1. Closing stock account is debited to the credit of trading account. Outstanding expenses, expense account is debited to the credit of outstanding expense. Prepaid expense account is debited to the credit of expense account. Accrued income account is debited to the concerned income account. Income received in advance, income account is debited to income received in advance account. Depreciation account is debited to the credit of fixed assets. Further bad debts account is debited to the credit of debtors account. Provision for bad debts, profit and loss account is debited to the credit of provision for bad debt account. Illustration: in the books of Lakshmi Enterprises, give the necessary adjusting entries for the following items as on 31st March 2015. A. Closing stock as on 31st March 2015, 40,000. Salary due but not paid, 18,200. Unexpired insurance on 31st March 2015, 4,500. Rent received in advance, 3,000. Interest due but not received, 1,200. Depreciation on fixed assets at the rate of 20%. Fixed assets in balance sheet, rupees 4,50,000. Bad debts to be written off, 15,000. Create provision for bad and doubtful debts at 5%. Create provision for discount on debtors at 2%. Debtors are appearing in the trial balance at 4,15,000. Solution: in the books of Lakshmi Enterprises, journal 1. Closing stock as on 31st March 2015, rupees 40,000. Closing stock is debited to the credit of trading account, 40,000. 2. Salary due but not paid, 18,200. Salaries account debited to the credit of outstanding salary account by 18,200. 3. Unexpired insurance on 31st March 2015, 4,500. Prepaid insurance account debited to the credit of insurance premium account by 4,500. Rent received in advance, rupees 3,000. Rent account is debited 3,000 to the credit of rent received in advance account. Interest due but not received, rupees 1,200. Interest due but not received account is debited 1,200 to the credit of interest account. Depreciation on fixed assets at the rate of 20%. Fixed assets in balance sheet, 4,50,000. Depreciation account is debited 90,000 to the credit of fixed assets account. Bad debts to be written off, rupees 15,000. Bad debts account debited by 15,000 to the credit of debtors account by the same amount, 15,000. Create provision for bad and doubtful debts at the rate of 5%. Profit and loss account debited 20,000. To the credit of provision for bad debt account 20,000, 5% at the rate of 15,000 minus 15,000. Create provisions for discount on debtors at 2%. Profit and loss account is debited 7,600 to the credit of provision for discount on debtors at 7,600. 2% of 4,15,000 minus 15,000 minus 20,000. Summary. Financial statements are the statements prepared at the end of the period with the twin objectives of calculation of result of current year's operations and to disclose the financial position at the end of the year. The users of financial statements include owners, management, employees, creditors, government, etc. In order to compute the results accurately, proper distinction is required between capital and revenue, personal and business expense, and periodic and non-periodic expenses. Trading and profit and loss account are prepared to calculate gross and net profits. The financial position is reflected through balance sheet.